The Reserve Bank left the cash rate unchanged at 4.1%, as was broadly expected by the consensus of economists and financial markets. But they really didn't give any guidance on what might happen next and played very much a straight bat. What was really clear in the statement is that they are faced with quite a lot of uncertainty at the moment, and they did reference that word quite a lot through the statement. They talked about uncertainty around the lags associated with monetary policy here in Australia. They talked about the uncertainty around the global outlook in the wake of the tariff policy that's been implemented by the Trump administration. And they also talked about uncertainties around the geopolitical environment as well. And then even when it relates to the path of inflation here in Australia and the path of household consumption, both of which really critical inputs into thinking about where the cash rate might head over the next couple of quarters, they noted risks in both directions. So talked about a world in which consumption here in Australia might do better than the RBA forecast, but also they could see circumstances where it might be weaker. And likewise with inflation, you know, although acknowledging it has come down a lot from its peak in the last couple of years, they do seem quite cautious about the outlook and did cite the possibility of, you know, risks in both directions. So the risk that inflation falls faster than they expect, but then also the risk that inflation stays higher than they expect.
And so is it clear to you what the board's biggest concerns about the outlook are, and whether indeed it could be that the biggest wild card for the domestic economy and indeed the global economy is Donald Trump's tariffs?
Yeah, I think that's right. So in terms of thinking about, you know, what's changed really since the Reserve Bank board met in February where they cut rates, you know, you would probably argue that if anything, the domestic economy has sort of broadly played out as they expected. Maybe the one sort of slightly positive development is that with some of the partial data we've had on inflation, it looks to be tracking a little bit better than the bank penciled into their forecasts in February. But the one thing that has really changed, I suspect, quite dramatically relative to their baseline expectations, even just 6 weeks ago, is what has transpired, you know, with offshore developments. And I think the story there really has been not that the Trump administration have used tariffs as a policy tool. I think that was well anticipated by most central bankers and most economists, but I suspect it's more around the magnitude of those tariff increases and also the breadth of those tariff increases. That's been the real surprise for most forecasters, and I suspect the Reserve Bank would be no different in that respect.
NAB has been forecasting another 4 cuts in the next 12 months. Does that remain NAB's forecast?
Yeah, absolutely. We haven't changed that forecast, and we are actually looking for another rate cut in May. And I think the sort of underlying premise for that forecast is really that we think inflation will print better for the first quarter than the Reserve Bank currently anticipates in its forecast. So that should give them additional comfort that inflation is on the right trajectory lower. So that's, I guess, the most important premise. But I think also when we look at the global backdrop, and the RBA did talk about this, you know, they are worried about the confidence impacts of tariff policy on businesses and households, and they're worried about the impact that it's going to have on global growth. So when they think about where and in which direction the distribution of risks have shifted to the global growth outlook, it's probably to the downside. And I guess if we think about monetary policy as really an exercise in risk management, I think what that tells you is if they get a good inflation outcome and they worry a little bit more about downside risk to the global economy, and they still, as they told us today, have the view that policy settings here are restrictive, then to me I think it makes sense that, you know, even just from a risk management perspective, it would be prudent just to take another 25 basis points off the cash rate in May.
Now, it was the first statement that we received from the new Monetary Policy Board today. It was a bit shorter than those we've received in the past. Have you any observations about how the process may have changed with an injection of new voices?
Yeah, so you're exactly right. So this was the first board meeting where we're now operating under a new governance structure for the board. So we've got one board that looks after the governance of the bank, and then we have another board who are responsible for the implementation and sort of guidance around monetary policy. So we heard from them today. It's probably a little bit too early to read too much into how that new board is going to operate, but I think the brevity of the statement today really just reflects the fact that there are a lot of uncertainties out there, and it's probably quite difficult for the board, whether it's fresh today or a couple of years in the making, to put down too much more on paper and sound reasonably confident about that. And that's probably especially the case this week, as we know we're facing into in the next couple of days a whole sort of raft of announcements on tariffs coming from the Trump administration. So I suspect the strategy today with the new board was to acknowledge sort of what's happened, but also acknowledge that they are operating in a world of elevated uncertainty, and in that context, it probably makes sense not to say too much.
Finally, the Coalition is proposing to relax home lending regulations as regards serviceability buffers. What is your view on whether such a policy would increase housing affordability?
Well, I guess the pure mathematics of that policy would be that if when you apply for a home loan, you don't have to build in as much buffer in terms of how high interest rates can go, then the mass of home loan applications would tell you that you can borrow more. And then I guess the question then becomes, what does that do to the overall level of housing prices in the economy? And so it may be one of those policies that in the short run might encourage or might enable more people to get into the housing market. But in the long run, that's, I guess, an additional source of demand in what we know is already a supply-constrained market. So pretty simple economics would tell you if you've got more demand and unchanged supply, all else equal, the prices go up. So it might be a policy over the long run that perhaps has some unintended consequences for housing affordability.
Sally Auld, good to speak to you.
Thanks very much, Kirsten.